Before we start this video, do like and subscribe to our channel and not miss on any updates.
Hello friends, welcome to the demo session of equity investments. Today we are going to discuss about dividend discount model, basically Gordon growth model. How is it used to value shares of a company? So, when you have multi-stage dividend models, you have single-stage dividend model, you have a terminal value concept, all of those are actually explained in this demo class. So, if you are looking for detailed lectures for CFA Level 1 as well as Level 2, we at OneFin by IndigoLearn provide CFA lectures by all CFA charter holders only, along with original material of Kaplan-Schweizer and with access to Kaplan-Schweizer MCQs. Okay, so without further ado, let's go and watch this demo on equity investments topic and very specifically on dividend discount models. So friends, now we're going to go and understand methods of valuing equity shares. We have three methods that we discussed. First one is cash flow or present value based. In cash flow, you take either dividends as cash flows or you take FCFE. And in second case, which is relative valuation, you'll go by PE or PB or P price to sales or EV by sales or EV by EBITDA. And then you have asset based valuation. First, we are going to look at discounting based models, and in that first one is dividend discount model. What is this dividend discount model? So let us go and have a look at it. So what is the formula under dividend discount model? Under dividend discount model, you have the formula of value of a firm is dt by 1 plus ke whole power t. Basically what you are doing is where is sigma t is equal to 0 to infinity. Now what you are doing is you are summing up d1 by 1 plus ke power 1 plus d2 by 1 plus ke power 2 plus so on and so forth. Please note, you are not discounting the current year dividend which is already paid, because it is no longer in the share. You are going to discount the next year's dividend which is going to come, and you are going to discount it by present value factor for the first year, and the present value factor is computed at the cost of equity. What is cost of equity? Cost of equity is we discussed it in the one of the chapters just 2-3 hours ago. If you go back, you'll see cost of equity is the expected return that the investor is expecting, or rather it is the return that an investor is expecting. So you find out cost of equity, and there are ways in which you use CAPM and find out cost of equity, and using that you discount the dividend. So you are discounting basically all the dividends, and these dividends, the formula is this, right? Formula is this: all future dividends are discounted. Now dividend 1 and dividend 2, if they are related, then the formula changes. Related means dividend 2 is dividend 1 into something. So let's say dividend 2 is equal to dividend 1 into 1 plus g, some growth rate. Then the formula can change. How will the formula change? If it is, we'll come to the formula, but first understand it is all present value of all dividends going forward till infinity. But can anyone know what are the dividends going to be till infinity? Nobody knows. Next year dividend probably will know. But what about this year after that? We will assume some growth rate. So if the company is growing very, very well, so you assume that D1, D2, D3, D4. You assume, let's say 2 years, from D1 it will go 5% and 5%. So from D1 it will grow 5%, from D2 it will grow 5%, from D3 it will go 5%, and D5 onwards it will grow only 1%. 1% of what? 1% of D4. So you may assume like this, or you may assume current year dividend is D1, from here onwards every year till infinity, D2 to Dn or D infinity, it will grow by 3%. You may assume either way. Why are you assuming this way? Based on what your understanding of normal growth in that industry is, right? Which way the industry is expected to head. So you can have growth rates that are high and then falling. You can have growth rates that are flat. You may also have growth rates that are low, then they go up, then they stabilize, come down and stabilize. Why will this happen? Because right now the company is in investment phase, so they may not be paying dividends. Slowly it will go up, then it will come down and market stabilize. It also stabilizes. It may be like this. So you can have any variety. Okay, dividends may be in any kind of structure. So when you follow a single dividend growth rate across periods, it is called a constant growth model. When you have different growth rates over different periods, it is called multi-stage model. You can compute it anyway depending on what the analyst assumption is. See, there is no world rule. This is not a science. Okay, there is no rule that dividends have to grow by 10% for next 5 years, then they have to go by 5%. There is no rule like that. Depending on which way the company grows, they will grow, and depending on how much company wants to pay, and depending on what actually the analyst is estimating. So there is no cardinal rule that everybody has to follow this logic. No, it is what you think will happen to the dividend of the stock. Okay, dividend of the company stock. Now, how is this arrived at? See, a lot of people don't get into this, but I like to explain why and how this comes, right? So let us say D2 is equal to, and we will take constant growth, D1 into 1 plus G. D3 is equal to D2 into 1 plus G. So D3 is equal to D1 into 1 plus G, which is basically this, which is equal to D2 into 1 plus G, right? So D3 is equal to D1 into 1 plus G whole square, correct? D3 is equal to D1 into 1 plus G whole square. Now, if you come back to this formula, what we were seeing here, or what we were seeing here, what is this formula? D1 by 1 plus KE whole square plus D1 into 1 plus G by 1 plus KE, not whole square, I'm sorry, by 1 plus KE. Then D1 into 1 plus G by 1 plus KE whole square plus D1 into 1 plus G by 1 plus G whole square by 1 plus KE whole cube. So first year, that is next year's dividend, you are discounting by first present value factor. 2 years later, 2 present value factors, but D2 is D1 into 1 plus G. So what is happening here? You have D1 as common. You take D1 common out. Then you have 1 by 1 plus KE. Okay. Then 1 plus G by 1 plus KE whole square. Okay. Like that you have stuff. Now this goes on. 1 plus G power n minus 1 by 1 plus KE power n. This is the formula. This is an infinite GP. A geometric progression where it is going infinitely. Why? Because we have assumed a constant growth rate forever in life. So what is the sum of infinite GP, if any of you guys remember? A by 1 minus R. A by 1 minus R. Now here let us assume 1 plus KE is A. What is R? R is term 2 by term 1. Term 2 by term 1. So what is term 2 by term 1? 1 plus G by 1 plus KE whole square divided by 1 by 1 plus KE. So this get cancelled. So R is equal to 1 plus G by 1 plus KE. Correct? So, right, A, what is A? A is the first term. So 1 plus KE, 1 by 1 plus KE, A by 1 minus R. First term is A. Right? A by 1 minus R. This is A. A is the first term, R is the ratio. Okay. 1 minus R. What is R? 1 plus G by 1 plus KE. So you simplify this, 1 by 1 plus KE by 1 plus KE minus 1 minus G by 1 plus KE. Okay. So 1 plus KE gets cancelled, 1 gets cancelled. This will be 1 by KE minus G. Correct? This is the value of which term? This is the value of this entire term. This is the value of this entire term. But you also have D1 here. So D1 into 1 by KE minus G, or D1 by KE minus G, or you can also call it as D0 into 1 plus G by KE minus G. So this is when you have a constant dividend. When you have multi-stage dividend, what happens? Let us say D1, first year is, let's say current year it is D0, D0 into 1 plus 10%, then D0 into 1 plus 10% whole square, then D0 into, in the fourth year, year 0, 1, 2, 3, fourth, in third year, 1 plus 10% whole square, that is, it has grown 10% for 2 years. Third year, it is growing by 1 plus 5%, and thereafter it is growing forever for 5%. So this is a multi-stage model. For initially there is some supernormal growth, then it is slowly coming down and stabilizing. So when you have a ratio like this, or when you have a dividend growth like this, you use this formula of D0 into 1 plus D1 by KE minus G from here, and you add the value of these dividends independently. What am I saying? I am saying, let's say D0 is 10 rupees. first 3 years dividend will grow by 10%. From year 4, dividend will grow by 5% forever. So how do you value? D0 is 10. It is relevant to us only for the purpose of computation of D1. So what is D1? D1 is 10 into 1.1. D2 is 10 into 1.1 whole square. D3 is 10 into 1.1 whole cube. Why is this whole cube? First year dividend is 11, then next year the 10% is on 11, 10% growth is on 11, which is why you are multiplying by 11 again into 1.1. D4 is equal to 10 into 1.1 power 3 into 1.05. So how do you value? What you do is, price is equal to, or price of a share is summation of all future dividends. Price is equal to sigma D, sigma present value of D. Okay, that is basically present value of all dividends. This is, let's say, cost of equity is, let's take some 4%. I am randomly taking a number. So first year 10 into 1.1 divided by 1.04 plus 10 into 1.1 whole square by 1.04 whole square plus 10 into 1.1 whole cube by 1.04 whole cube plus 4th year onwards it is a static dividend. So 4th year onwards it is a static dividend. So what do you do? 4th year dividend is what? You have to arrive at the value. From 4th year it is constant, no? So 4th year number, this is constant. So D4, which is 10 into 1.1 whole cube into 1.05 by 1.04 whole power 4, this is the 4th year dividend. Okay. If you do till here, you have taken values of all dividends till year 3. Year 4 onwards is the price, reflects the price on as on 4th year. So these three reflect the, these three are basically that element of the price which is for next 3 years dividend. From here onwards, it is that part of the price which is pertaining to 4th year dividend. From 4th year dividend, what you do is, either you do this and compute 4th year, and then from 5th year onwards compute a constant growth, or don't do this, compute 4th year itself constant growth. Okay. What I am saying is, either compute this and 5th year onwards constant growth. What will be 5th year constant growth? Let me take this example. This is 1.1 power 3. Yeah? 1.1 y power x 3 is equal to 1.331 into 1.05 is equal to into 10. You basically get this part as 13.9755 divided by 1.04 is equal to divided by 1.04 is equal to divided by 1.04 is equal to divided by 1.04 is equal to, you get 11.946. So this is the dividend of the 4th year. You take dividend of 4th year, and from 5th year you assume a constant dividend, or you can directly assume from this point itself the dividend is constant. Why? But the dividend growth rate is constant. My bad. Either you take 4th year dividend value and from 5th year you take dividend growth rate as constant, or you take from 4th year itself dividend growth rate is constant. Okay. You can do either ways, you will get the same answer. I will show you how you will get the same answer. Right. In fact, I think it is better to show this in Excel. That way it is easier. I will not spend time on computing using calculator. Of course, you have to use calculator in the exam, but when I am explaining this now, I do not want to use that. Okay. So first year dividend is 1, 10, D0, D1, D2, D3, D4, dividend growth rate 10%, 10%, 10%, and from here onwards it is 5%. Discount factor is 4%, correct? Okay, period is 0, 1, 2, 3, 4. Right. So dividend first year D0 is 10, D1 is equal to 10 into 1 plus 10% whole power 1, correct, divided by 1 plus 0.4 power 1, which is what we just saw, no? That is what I wrote in the tablet a few minutes ago. $10.57692. Second year, the dividend will be $1.1 whole square divided by 1.04 whole square. Third year, 11.83, which is 1.10 into 1.1 whole cube divided by 1.04 whole cube. In the fourth year, what you will get is 10 into 1 plus 10% whole power 3 into 1 plus 5% divided by 1 plus 4% whole power 4. So, you will get 11.9463. What did we get? 11.9463. I was just telling you the same number. So, fourth year present value, again I am looking at present value of fourth year dividend. I am not directly looking at fourth year dividend. So, fourth year dividend actually will be, first year dividend is 10 into 1 plus 10%. Second year dividend will be 11 into 1 plus 10%. Third year dividend will be 12.1 into 1.1. Fourth year will be 13.3931 into 1.05. This is the dividend. But what is the present value factor? 1 by 1 plus 4% power 1. So, this is the first year PV, second year present value factor, third year present value, fourth year present value factor. So, if you multiply these two, you are getting the values what I just showed you in column number D. Okay. So, if let us say this is the fourth year dividend. Now, from here onwards it is growing constant at 5%. So, what is the formula? D1 by KE minus G, that is the formula, correct, for infinity. So, if we assume D4 as D1, if you assume D4 as D1, you can also assume D5 as D1. First, let us assume D4 as D1. If you assume D4 as D1, what will happen? That year's dividend is how much? That year's dividend is 13.9755. 9755 divided by KE minus G. What is KE here? KE, cost of equity, your cost of equity cannot be less than your growth rate. Okay. Cost of equity has to be higher than the growth rate. So, instead of 5%, let me take this as 3%. Okay. If I take this as 3%, obviously things will change. Why cost of equity cannot be less than G? Because if cost of equity is less than G, here KE minus G will become negative. If you divide something by negative, you will get a negative value. So, share cannot get negative value, no. So, the cost of equity is higher than the growth rate. Cost of equity is higher than the growth rate. So, you will have to arrive at a growth rate that is higher than cost of equity. So, you have to at least project for that level of time your growth rate, dividend growth rate, till the time your growth rate falls below KE. That is one very, very important factor. Okay. So, now what is your D1? When you say D1, here basically for fourth year dividend, you are assuming it as D1. So, D1 present value of all future dividends from D1 period is D1 by KE minus G, 13.7903 by, which is the dividend. Please do not take the present value of dividend, take the dividend value by KE. What is cost of equity? 4% minus G, which is 3%, right. This gives you 1370. Now, what is this 1370? This is the value of the share on D0. But here D0 is what? D1 is fourth year. We have taken fourth year dividend as D1. So, value of share is 1 year prior to that. So, this is P3. This is what? This is P3. Did you understand this logic? If you not, I will explain again. From fourth year onwards, dividend growth rate is constant. So, if dividend growth rate is constant, you can use this formula. If you are using this formula, D4 as treating it as D1, where you use formula D1 by KE minus G, you are getting a value on D0. But here D4 is D1. So, D0 will be 1 year prior to that, which is P3. So P3 will be the value of this share. Now P3 is the value of the share at what? When you say P3 means at the end of period 3, this is the value of the share. But what is the value of, what are we trying to find out? We are trying to find out the value at P0. P0 means today, right? Today what is the value? You simply multiply this, your third year price with the third year present value factor, right? So you get the P0 component of, you get the terminal value component of P0. So you are bringing forward this 1370 to here. Is this the price? No. We also have to add these three cash flows. Why? Because dividend, because the share is summation of D1 plus D2 plus D3 plus D4 and so on, plus D1 plus D2 plus D3 and D4 and so on. And we are also saying D4 onwards, we are arriving at a single number, and that single number D4 we have brought it to present value. So D1, D2, D3 also you have to bring them to present value. So you add to this summation of present value of D1, D2 and D3. Okay, I am going to give this Excel sheet as part of the course, so don't worry about it. If you have understood it, it is logical. So the price of the share is 1370 ka present value for 3 years plus present value of all dividends for 3 years, right? And what is 1370? 1370 is the third year price assuming constant dividend growth rate from 4th year. Now here we have got P0 as 1252. Now here what did I tell you? You can assume D4 as D1. Can you assume D5 also as D1? Yes. So let us see what will happen. D5, 5th year. What will be D5? What will be D5? D5 will actually be your D4, whatever is the dividend, multiplied by 3%. What is the present value factor for 5th year? Same 4%, 1.04 power 5, you get the 5th year value, which is present value of your 5th year dividend is this much, 11.6061. This is the present value. But what is D5? D5 is this, right? Now when you compute P0 using D5, okay, this is P0 using D4. So if you compute P0 is equal to D using D5, you have two parts. This is first present value of 4-year dividends, then price at the end of year 4. What is price at the end of year 4? What is price at the end of year 4? Price at the end of year 4 is assuming D5 is D1, correct? When you use when you treat D5 as D1, you will get P4. So you're plus P4. Plus present value of P4. Now what is P4? P4 is equal to present value of all dividends that are growing at a constant rate from D5. What is the formula for it? Same, D1 by K minus G, and here we are looking at P4, so it is D5 by K minus G. What is D5 by K minus G? We got dividend value as what? 14.12, right? So is equal to 14.12 divided by K minus G. What is cost of equity? Cost of equity is 4%, G is 3%, right? So this is P4, but this is P4. What do we want? We want present value of P4. What is present value of P4? P4 into present value factor for 4th year. What is present value factor? We just now computed here, 0.8548. So into 0.8548. Now you got present value of dividends till 4th year, price of the share at the end of 4th year. If you add these two, how much did you get? 1252.35. You got the same answer as what you got here. So whether you consider you take P0 using D4 and then computing the price at the end of P3, or you can take P0 using D5, that is you are computing dividends till 4th year and taking price at the end of the 4th year, you are going to get the same answer of 12.35. Okay, so please don't get confused whether you should do till this year or that year. Whatever you do, you will get the same answer. There may be some minor differences when you are rounding off and all that, otherwise you will get the same answer. This is a multi-stage model, and I have explained to you both multi-stage as constant growth in the same example. Okay, now let us understand some important elements of this. See, there are other valuation related issues and other concepts also. I am not going in the exact order of the material. I am slightly jumbling because there is a flow to this. Okay, I want to go with my flow rather than the material flow. Okay, but I will be ensuring that I will cover everything. So, okay, don't worry about it. Now, what is the key aspects that you have to recollect? this is dividend discount model or Gordon growth model. Okay, it is called either ways. You are discounting dividends, in that you are applying this formula. P0, which is price of the stock as on today, is equal to D0 into 1 plus G by KE minus G, where KE is greater than G and G is constant dividend growth. If you don't have constant growth initially, you will do D1 plus D2, present value of D1 plus present value of D2 plus present value of D3 plus D4 by KE minus G. Okay, where assuming that from D4 onwards everything is stable. Okay, so this is one way you do. Now let us say if the growth is not there, same formula, in the same formula, D0 into 1 plus G by KE minus G, assume for a moment there is no growth. What is the value of growth here? 0, right? So D0 into 1 by KE. So what will happen to the formula? If today's dividend is 10 and next year's dividend is also 10, because there is no growth, next year is also 10, next year is also 10, the cost of equity, let us say, is 5%. So you are doing, in this formula, if you substitute the, even if you compute an infinite GP with 1.05, 1.05 whole square, so on and so forth, you will get the same answer, which is D0 by KE, which is 10 by 5%, which is 10 by 0.02, which is 10 by 0.05, I am sorry, which is 10 by 0.05, which is 10 into 20, which is 200, which is 10 into 20, which is 200. So if dividend does not grow, then your value of your share is simply 10 by the cost of equity. Here this is cost of equity, do not forget it. Where are the scenarios where you will have stuff like this? Where does dividend not grow? You may have this, please recollect stuff we have discussed, perpetual preference shares, or sometimes in case of perpetual debt also. There are, in India we don't have perpetual debt, banks are allowed to issue perpetual debt, but corporations maybe do 99-year debt and all of that. But if you imagine you have perpetual debt, that is forever there is debt, then what do? You do the same thing. Whatever is the face value of the bond into coupon by discount rate. Or if it is a preferred share, you do preferred dividend. Why? Because it is always fixed, it does not change, divide by discount factor. Why? What is this? D0 by KE, this is also same thing, D0 or coupon by KD, right. So when you have non-growing, there is no growth, then this formula comes. And where did we get this? We got it by substituting 0 here. Even if you do that sum of infinite GP for a series which is like this, what is that series? 10, I wrote here already. Where is this? 10 by 1.05, 1.05 whole square, so on and so forth. You do D0 by 1 plus KE, D0 and D1 are same, D0 by 1 plus KE whole square, where 1 by 1 plus KE is R, right. So 1A by 1 minus R, you substitute this formula, you will get the same answer, which is D0 by KE, you will get that answer only, okay. Don't worry about it unnecessarily, remember this particular formula. Now, after having understood this, I briefly mentioned what is cost of equity. Now, let us understand where does this cost of equity come from. What is KE? KE, I simply said, it is the cost that is expected, and using CAPM you can find out. How do you find out using CAPM? CAPM formula says KE is equal to risk-free rate plus beta into market risk premium, which is risk-free rate plus beta into return of the market minus risk-free rate. Right. So this beta is the same beta that we have been discussing in, I think we have discussed this in portfolio management chapter, where you probably would have heard it in, other chapters. If not, it is something very simple. Beta is sensitivity of stocks returns. Let's say we are trying to find out KE of HUL. We are looking at HUL's stock daily returns. Yesterday it was 101, today it is 102. So it is grown by 1 on 101. So 1 by 101, which is 0.09%. So like that you compute the returns on a daily basis for a long period of time. You also compute the returns of the market. Let's take Nifty. Nifty daily returns you compute. You regress both of them and find out beta. This is that beta. Sensitivity of the stock price to stock returns to market returns. I'm sorry, stock returns to market returns. This beta. You input this beta here, take the risk-free rate, take the return on the market, you can find out the expected return or basically the cost of equity of a share. This cost of equity is what you use here as denominator. Okay. Then let us come to the next aspect. What is this G? Kya hai G? Okay. G is growth rate. Please remember there is something called ROE. ROE is not equal to your cost of equity. Don't get confused. ROE is what? ROE is, if you remember just few sessions ago we discussed about it. ROE is your PAT or net income by average net worth. Okay. This is a book formula. Book. This is market. Don't combine or confuse them. There is a way in which both of them get linked, both of them are used in the formula and all that. But don't think ROE is KE. Please don't make that mistake. Now what happens? What is growth rate of dividend? If a company is generating, let's say 100 rupees PAT, and let's say its net worth is 1000. Net income is 100, net worth is 1000. Okay. Let's take average net worth is also 1000. Okay. Then what is the ROE? ROE is 100 by 1000, which is 10%. Okay. Let us say we do this KE computation. Whatever is the KE we get it as KE is equal to, let's say, some 7%. Cost of equity is 7%. Now, in a P&L, let us say, out of this 100 of net income, the company declares 50 as dividend. Okay. 100 net income, 50 dividend. So 50 retained earnings. Let me not take 50. 50 are same, no? So I will take a different number. 45, 55. 45 is dividend, 55 is retained earnings. So let us assume there are 100 shares. So what is EPS? 100 divided by 100, which is 1 rupee. What is a DPS? DPS is dividend per share. Dividend per share is 45 divided by 100, which is 0.45. What is retained earnings per share? 55 divided by 100, which is 0.55. So far so good. Now, if company is getting a return of equity of 10%, what does it mean? It means company is able to deploy equity and generate a return. Assume for a moment that whatever profit I have generated today, next year I am able to invest, I am able to generate return. So next year I will generate return of same 10%, no? Assuming that moment I get, I am deploying it and again I am able to generate return. So on this 55, which is retained with the company, you will next year you will generate 10% return. Correct? So what is your net worth? Originally your net worth was 1000. Then you retained some earnings of 55. So your new net worth is 1055. On entire 1055, you will now generate 10% as ROE. So your net income next year is 1055 into 10, which is 105.5. 105.5 it has grown to. So 100 to 105.5. Your retained earnings rate, this has grown by 5.5%. Don't you think it is very, very close to this 0.55 of retained earnings, where retained earnings is what? 55% of EPS, correct? No? 1 rupee is EPS, 0.55 is retained earnings, 55% is this. So actually this growth is your retained earnings into ROE, or 1 minus dividend payout into ROE, or B into R. You know, there are multiple terminologies that are used. B is retention ratio. What is retention ratio? 55%. R is what? ROE. ROE is how much? 10%. 10% only, no? ROE. We said everywhere 10%, 10%. Into 10%, that is 5.5%. So G is equal to retention rate into ROE. So D0 into 1 plus G, right, by KE minus G. this can be rewritten as D0 into 1 plus BR. B is retention ratio into ROE by KE minus G. Okay, so it can be rewritten like this. Now, why am I saying all this story? Because there are 3-4 points I wish to highlight. What are the 3-4 points? First, as KE is greater than G, if KE becomes more and more greater, what happens to the denominator? So, let us say KE is 10, this is 3. Okay, correct? 10 is greater than 3, so you have 7%. Now, let us say this is 10 and this is 9, denominator is 1%. So, if you divide 100 by 7%, okay, let us say the numerator is 100 and 100 by 1%, where do you will get more value? 100 by 0.07 or 100 by 0.01, where will you get more value? Obviously, you will get more value here. So, as the difference between cost of equity and growth rate keeps widening, the value of the stock keeps coming down. So, which one is higher? 100 by 0.01 is higher. So, as the gap between KE and G widens, that is you are not growing close to the cost of equity, you are growing far lesser than cost of equity, your value of the share comes down. Then second point, as the difference narrows, that is if the difference is 0.01, the value of the share goes up. Third point, for small changes in this, in the denominator KE minus G, so 100 by 0.01 versus 100 by 0.02. What is this? This is 10,000, this is 5,000. So, a 0.01 change in the denominator causes a 50% change in the ending value. Okay, numerator being the same, denominator changes 0.0 by 0.01, the value of the eventual answer changes by 50%. So, it is you have to be very careful with that. Then this G is sustainable growth rate. G is sustainable growth rate. Now, there is one point I wish to highlight. Okay, so there are a few points that I wish to highlight. Let us go and actually look at the material what they have given, because I think this basic understanding, or rather I have gone fairly in depth. I just want to ensure that I have not missed out anything. So, we will quickly scroll through whatever is there, right. So, first we said value of a firm. Value of a firm is summation of all dividends. When you take dividend per share, it is value of, it gives you value per share. Okay. Then value is equal to, for a 1 year holding period, dividend to be received, present value of dividend, plus next year's price, present value, correct? This is the value today is equal to next year's price, present value, plus next year whatever dividend you are going to get next year, present value. Then value after 2 years is present value of dividends for 2 years, plus whatever is the price after 2 years, present value of price after 2 years. Then I have already solved problems like this, so no need to get into this. Okay. Then this part, FCFE, we will come to FCFE. First, let us finish off this dividend discount model, then we can come to FCFE, because just like you are discounting dividends, you can also discount free cash flow to equity. What is that? We will come to it, but we will come to that later. Then we have also discussed about what is cost of equity and CAPM model, that is also done. Then preferred stock, I told you preferred stock is because there is no growth rate in dividend, it is DP by cost of preferred stock. Then calculate, interpret the intrinsic value of equity security based on Gordon constant growth model. So, dividend discount model is where you discount all the dividends. Gordon model is basically that formula D1 by KE minus G. So, D1 by KE minus G, this is the formula, this is what we discussed. And dividends are appropriate measure of, so the assumptions of Gordon model are dividends are appropriate measures of shareholder wealth, constant growth rate G and required return on stock K are never expected to change, and KE must be greater than G, otherwise math will not work. Then this example again, there is no need to discuss, we have already discussed this in depth. So here please note this, when solving stock valuation problems in the exam, watch for words like forever, infinitely, indefinitely, for the foreseeable future, and so on. These will tell you that the Gordon dot model should be used. Okay. Also watch out for words like just paid or recently paid. This will tell you it was D0. Words like will pay or is expected to pay is D1. Then we discussed what happens to if the gap between KE and G widens and narrows and all of that. Then there is this point. An analyst can also use the Gordon GGM to determine how much of the estimated stock value is due to dividend growth. To do this, assume the growth rate is 0 and calculate a value, then subtract this value from stock value using a positive growth rate. So, assume, calculate the value of a stock that paid 1.5 dividend last year. Its dividends are expected to grow at 8% forever and required return on equity is 12%. What is this? D1 by KE minus G. What is D1? 1.5 into 1.08 by 12 minus 8, which is by 4%. So, 1.62 by 4%, which is 40.50. What they are saying now is, out of this 40.50, how much is coming from growth of dividend? How will you do growth of dividend? You simply do 1.5, which is the dividend, by KE. Assuming that there is no growth, the value of dividends alone is 12.5. So, growth is 40 minus 12.5, which is 28. Did you understand? Assume that there is no growth in dividends, so then you will get just the present value of dividends, simple dividends which are not growing. Subtract that from the value that you previously arrived, you will get the growth value or the amount of price of the share which is attributable to the growth in dividends is $28. How do you estimate the growth in dividends, which is what I was telling you? Use the historical growth in dividends for a firm, use the median industry growth rate, estimate the sustainable growth rate. And I also told you sustainable growth rate G is 1 minus dividend payout, which is retention ratio into ROE. Okay, then what is G? We have computed this. When we look at examples, we can figure this out. Now, some firms do not currently pay dividends, but are expected to begin paying dividends at some point in future. A firm may not currently pay dividend because it is in financial distress and cannot afford to pay out cash, or because the return the firm can earn by reinvesting is greater. For these firms, an analyst must estimate the amount and timing of the first dividend in order to use the Gordon growth model. So, if you believe something like Zomato will not pay dividends for next, let's say 5 years, or Swiggy will not pay for 5 years. Then how will you value? For first 5 years, you don't take anything. Subsequently, you start taking dividends. For arrive the value at P5, discount it to P0. That is how you do it. They have given an example of a firm with no dividend. A firm currently pays no dividend, but is expected to pay dividend at the end of year 4. So, end of year 4 meaning you can figure out the price at end of year 3. Year 4 earnings are 1.64, firm will maintain dividend payout ratio of 50%, assuming a constant growth rate of 5, required rate of 10, estimate the value of the stock. Very, very simple. D1, what is D1? Fourth year dividend, which is EPS into retention rate, into 1 minus retention rate by KE minus G. So, you get 16.4 as value at the end of year 3, which you again discount to present value by discounting it to or multiplying it with the present value factor for 3 years. Okay. Then we discussed about multi-stage models. How are multi-stage models done? Determine the growth rate, project the size of initial dividend, estimate dividend during high growth period, estimate constant growth at the end of high growth period, estimate first dividend that will grow at constant rate. So, like that we have already seen this. So, there is no need to get into further details. Here, one thing I wish to highlight. Many finance textbooks solve multi-stage growth models like this one, that is by using first dividend that has grown at constant long-term rate to calculate the terminal value 1 period after the dividend we have used, except for rounding this results in the same stock value. So, if you remember, I said whether you compute P0 using D4 or using D5, if you use D5, you discount P4 present value. If you do D4, you compute P3 and discount it to P0. Either ways, you will get the same answer. That is all they are trying to say. A common mistake with the multi-stage model is to calculate the value of P1 in this example and then to forget to discount it back to the present value or discount this over the periods until the constant growth is paid, rather than using the correct number of periods. Don't make this mistake. So, what are they saying? Here, if I had to compute P0, I did two things. I added all the discounted dividend present values or the present values of discounts and also added the present value of the P3. Don't forget either part. Don't say directly, if you add directly P3, gone. If you add only the discount value of dividends, gone. You have to add both of them. Present value of discounts, present value of dividends and present value of price. Both have to be done. In the exam, they will give questions where to confuse you. They will just, in one option will have an incorrect option where they will just simply add the present, instead of adding present value of future price, they will directly add the future price itself. Or instead of adding the present value of dividends, they will directly add the dividend. So, don't make that mistake. Be very, very careful. That is what they are trying to highlight. Identify the characteristics for companies for which the constant growth or multi-stage model is appropriate. it uses a constant model. For whom is it appropriate? Most appropriate for valuing mature, stable and non-cyclical dividend paying firms. For paying firms which are high growth rate, where the dividend is expected to grow high, slowly or erratically, you should first project dividends till the time they become constant, and these dividends you should take as multi-stage, and subsequent dividends you should take at constant stage. So that is the thing. Then the one variant of a multi-stage model assumes firm has 3 stages, not 2: hyper growth, normal growth, constant growth. So you can have 3 stage, 4 stage, 5 stage. There is no end to this, right? When a firm does not pay dividends, estimates of dividend payment some years in the future are highly speculative. See, this is what I was telling about Zomato, Swiggy. If they're not paying dividends, how can you project dividends 6 years later? You don't know. At that point of time, how will you value? You will value using FCFE. In any case, where future events cannot be estimated with much confidence, valuation based on FCFE is appropriate, as long as growth rate of earnings can be estimated. In other cases, valuation based on price multiples may be more appropriate. So if you're not able to value using dividends, you're not able to project dividends, then do FCFE. What is FCFE? We will understand. That is one small part I did not discuss so far, because I was more keen to get this entire stuff around Gordon growth model and others out. Now we will go to this FCFE. It is a very, very simple thing, nothing complicated. You would have already seen. If you do not know, I will explain now. FCFE, free cash flow to equity. Now in this there are certain differences. Indian audience especially should note this. I'll first give the formula and then I'll explain the difference. Okay, what is FCFE? FCFE is net income plus depreciation. So you're basically PAT, adding back a non-cash item called depreciation, minus increase in working capital. Basically, whatever is the money that is going out for working capital, minus fixed capital investment, which is basically any new capex that you incur. Okay, adjusted for any sales of fixed assets. Okay, if there are sale of fixed assets and money is received, that is subtracted from capex. Okay, then minus debt, principal repayments, plus new debt taken. Okay, this is the formula. Now you are going to learn more about this in depth in level 2. We have not covered this so much in level 1 with respect to questions and all of that, but this is the formula. Okay, this can also be computed as cash flow from operations minus fixed capital investment plus net borrowing. So this is called net borrowing. Okay, new debt raised is borrowing, right? Borrowing minus repayments is net borrowing, and this is fixed capital investment. These two are not part of cash flow, are not used in cash flow from operations. Why? Because CFO is equal to net income plus depreciation minus increase in working capital. This is US formula. Why is this the US formula? Because in US, interest expense is an operating item. In India, interest is financing activity. Because we are studying CFA, we will follow this logic where interest, if you have seen in the financial statement analysis topic, Vamsi would have explained, the faculty would have explained that cash flow from operations is basically your net income plus depreciation minus increase in working capital. There is no interest charge, whereas in India there is an interest charge. Because there is an interest charge, you have to make adjustment for interest also, whereas in this case you need not make. And please note, when you make adjustment for interest, whatever you see, it is not relevant for us here, which is why I will not go deep into it. But please note, all these items, net income is a direct post-tax item. Depreciation is a non-cash charge. So it is whatever is the benefit of depreciation is already, tax benefit of depreciation is already taken into account, so you can fully add back the depreciation. Working capital is got nothing to do with your P&L. Fixed capital investment, nothing to do with P&L. Debt repayment, nothing to do with P&L. All items are post-tax. Net income and post-tax. So in Indian context, if you do wish to add back interest or subtract interest or whatever, you have to take the impact of interest, tax on interest. Okay, so keep the Indian context aside. Let us look only at US context, which is net income plus depreciation minus increase in working capital minus fixed capital investment and plus any net debt, right, or CFO minus fixed capital investment plus net debt raised. Now this is FCFE. What do you mean by FCFE? It is basically free cash flow that is available to shareholders. See, because when you talk about net income, right, net income is profit. Profit is not cash flow, no? There are differences. What are the differences? You may have working capital issues, you may have debt related issues, you may have depreciation, because depreciation is non-cash charge, right? So you are adjusting all of that and saying there is this one number which the equity holders have a cash flow right over, or rather the cash flow pertains to these equity holders. That is called FCFE, which is what we have computed here. Now the same FCFE, if you do not have dividends, you can compute the value of the firm using FCFE. You say how FCFE 1 by 1 plus KE, FCFE 2 by 1 plus KE whole square, so on and so forth. You can use the Gordon growth formula also. Everything can be done on FCFE also. But please note, when you do P0, you are doing per share. So you are taking dividend per share, earnings per share, everything. Whereas when you do V0, you are doing everything value of firm. So it is entire equity value, not even firm, value of equity. So this V0 what you got, if you do FCFE per share, then you will get price per share. So P0 is equal to FCFE or present value of FCFE per share. So if you do V0, it is simple discounting of all free cash flows to equity at a gross aggregate level. If you divide this by share count, then you get the per share price. Okay, so this is the formula. This basically is what your cash flow based or present value based valuation. Now, after having understood all of this, I think we have covered everything. I have not solved some of these problems because they are very simple. It is more important to understand the formulae that what we have been going through. So what I will do is we will directly go and solve some questions that are given, right, that are given in this particular topic, and then we will move to the next aspect. Okay. So what are the questions given? Let us have a look. 7 questions. Interesting. The constant growth model requires which of the following? G should be less than K, greater than K, not equal to K. G should always be less than K. Otherwise, denominator becomes negative and math will not work out. What would an investor be willing to pay for a share of preferred stock that pays $7 annual dividend if the required rate of return is 7.75? What is it? D0 by KE or KP here. So 7 by 7.75%. So 7 divided by 0.0775, which is 90.322. What is the answer here? Yes, answer C, which is 90.32. Then an analyst estimates that the stock will pay a $2 dividend next year and it will sell for 40 at the year end. Its required rate of return is 15. What will be the value of the stock? What is the value of the stock? Value of the stock today is dividends for next period and price at the end of next period. What is the price and both of them present values? Price at the end of next period is what? 40 and dividend is what? 2. So you take 40 plus 2, 42, divide by what is the discount factor? 15% by 1.15. So 42 divided by 1.15, 36.52. Answer is B, 36.52. Next, what is the intrinsic value of a company if dividends are expected to grow at 5%? The most recent dividend, so previous dividend was 1 and investors require a rate of return of 10%. So next year dividend is 1 into 5, 1 plus 5%, so 1.05. 1.05 is D1 by KE minus G. What is KE? KE is 10. G is 5 by 0.05 by 0.05 is 21. Where is this? Yes, 21 is answer B. Next, assume a stock is expected to pay dividends at the end of year 1 and year 2 of 1.25 and 1.56. Dividends are expected to grow at 5% thereafter. Assuming KE is 11%, the value of the stock is closest to what? So, year 1, dividend is 1.25, year 2, 1.56, year 3, 1.56 into 1.05 forever. K is equal to 11%. What is the value of the stock? So 2 years dividend present value 1.25 by 1.11, 1.56 by 1.11 whole square plus, if you can value at the end of year 2, what is the end of year 2? Plus present value of P2. P2 is equal to D3 by KE minus G, which is 1.56 into 1.05 divided by 11% minus 5%. So P2 is equal to 1.56 into 1.05 divided by 0.06 is 27.3. Okay, present value of 27.3. Then 1.25 by 1.11 is equal to is 1.126, and 1.56 divided by 1.11 is equal to divided by 1.11 is equal to 1.2666. Okay, 1.2666 plus 1.126 is equal to 2.39 plus 27.3 divided by 1.11 whole square. 27.3 by 1.11, which is 22.15. So 22.15 plus 2.39. Answer is 24.54. 24.54. Please note, you got 24.54. If you had forgotten to discount something or if you directly added, you will probably get a different answer. Answer is 24.547, so 55. Then an analyst feels that Brown company's earnings and dividends will grow at 25% for 2 years, after which growth will fall to 6%. The projected discount rate is 10%. Brown recently paid 1. The value of Brown stock using multi-stage model is close to. So recently paid 1. So next year's dividend will be 1.25. So 1.25 for the first year, 1.25 for year 1, this is D1. For D2 it is 1.25 into 1.25, which is 1.5625. Year 3 is 1.5625 into 1.06, right, by 10% minus 6%, right. I am not showing you the screen because you are supposed to solve along with me. Okay, you are supposed to get the right answer. Okay, 1.5625 into 1.06, this is the third year's dividend, this is 1.656250, divided by 0.04 is 41.4, and we have to take present value of 41.4 for 2 years. So 41.4 divided by 1.1 is equal to, divided by 1.1 is equal to 34.22. This is the present value of P2. Then 1.25 divided by 1.1 is equal to is 1.136. 1.5625 divided by 1.1 is equal to, divided by 1.1 is equal to, then 1.5625 divided by 1.1 is equal to, divided by 1.1 is equal to 1.2913. Okay, 1.2913 plus 1.136 plus 34.22 is 36.64. Do we have that option? Yeah, 36.64. Next, last. Which of the following firms would most likely be appropriately valued using the constant growth dividend discount model? Auto manufacturer, producer of bread and snacks, biotechnology firm. So biotechnology, definitely no. Auto definitely goes through cycles. So steady, stable is bread and snacks because their earnings will not change. Okay, so that is the answer. Let us see if we've got all correct or is there any issue? Yes, all correct. Okay, so now we have understood the entire cash flow based or present value based discounting of or based method for arriving at value of an equity share or value of equity portion of a firm, right? Next, we will move to relative valuation or multiple based valuation, and then asset based valuation. So friends, I hope you've seen the demo session of equity investments dividend discount model topic. This is how we teach in the actual class. We try and explain the concept, we try and explain various angles, facets attached to it, and also try and solve some problems related to it. If you're looking for level 1 or level 2 classes, look no further. Please enroll today at OneFin by Indigo Learn. Reach us at our number in the description below. So please do stay subscribed so that you can get further updates, more information on scholarships, more information on exam dates, more information on how to prepare, and all of that on our channel OneFin for CFA students. All the very best.